Hello and welcome to the Engaging Economics webinar series, brought to you by the Master of Science in Applied Economics, the Master of Science in Financial Economics, and the Johns Hopkins University Office of Advanced Academic Programs. Today's event features a discussion on debating deglobalization. My name is Peter Huggins, and I'm the event producer. Please note today's event will be recorded and uploaded to the AAP YouTube channel under the Engaging Economics playlist. During the program, if you have any questions, please feel free to use the Q&A function, and we will answer as many questions as possible during the latter portion of the event. With that, I will turn over the event to our moderator, Dr. Prakash Loungani, Program Director and Senior Lecturer for the Master of Science in Applied Economics program.
Thanks very much, Peter. Welcome, everyone. I'm joined here by Oh Hu, who's Program Director for our MS in Financial Economics, as well as by Shekhar Iyer, who is on leave from the IMF at Johns Hopkins this year, also a fellow at Bruegel and NCAER. He's working on a book called In Defense of the Liberal Economic Order from a non-Western perspective. Let me turn to our two guests today, Dani Rodrik and Joyce Chang. I'll start with Dani Rodrik, who you all know is a famous political economist at Harvard. And his bio was given in the event, so I will not repeat it. Dani, welcome, and thanks for taking the time to debate deglobalization with us. Let me ask you first that you have been sort of critical of what you've called hyper-globalization. For our participants, would you tell us what you mean by that term and why is it that you have been critical of it?
I use the term hyper-globalization to signify a couple of things. One is that that there are different globalization models, and the framework that governed the world economy from the 1990s on was very different from the model of globalization that we had prior to then, which was sort of the Bretton Woods set of arrangements. I think qualitatively, hyper-globalization was very different than the Bretton Woods model in pursuing a kind of a very deep economic integration, both in terms of a set of extensive trade agreements that put the pursuit of market access ahead of a lot of other economic and social objectives, and a model of financial globalization of the presumption that capital, including short-term finance, should be free to move across borders, and other objectives should take second seat to the freedom of capital mobility. And so the models of deep economic integration through trade agreements and financial globalization really characterize hyperglobalization as a very different set of arrangements than the Bretton Woods model. And I've been a critic of hyperglobalization for essentially two reasons. One is that in some respects it went too far, in other respects it didn't go nearly far enough. And I think where it went too far is in creating a set of normative prescriptions about how countries should pursue their economic development policies, putting the goal of international economic integration first and foremost, that really restrained a number of other objectives, or constrained the pursuit of other objectives. For the advanced economies, that was largely the pursuit of equity, internal equity, the moderation of regional and labor earnings gaps, and creating more inclusive societies. For a lot of developing countries, it was constraints on how far they could go in terms of pursuing industrial and other structural policies to restructure and diversify their economies. And paradoxically, actually, the country that did the best during this period of hyperglobalization is precisely the one that violated these normative precepts, which is China, by pursuing a sort of policies that were more reminiscent of Bretton Woods arrangements, which essentially enable countries to engage in selective trade protection, in industrial policies, in managing actively the exchange rate, in restricting capital flows, all of which were no-nos under hyperglobalization, but which China extensively engaged in, on the one hand, while leveraging the global economy to use these policies to keep itself a sort of a sphere of autonomy through which it could restructure and upgrade its economy. And countries that ruled by the precepts of hyperglobalization did much worse. The respect in which I think hyperglobalization fell short, and that would be my second criticism, it created blind spots with respect to true global public goods on which we could be focusing on. And I think obviously the one such area is climate change and the things that we need to do collectively on climate change. A second area, which I think that became painfully obvious, is with respect to global public health. So I think these kind of blind spots were sort of, were reflected in our priorities of pushing deep integration in the areas of trade and finance at the expense of, I think, much more important global priorities.
So, one would guess, given that you were critical of this deep integration, that you're not totally upset by the reversal of some of it. In fact, I think you've written that one should not fret about deglobalization. Can you unpack that for us a bit? Why should we treat this more as an opportunity rather than a disaster?
Yeah, I mean, I think hyperglobalization was really unsustainable. I think, it had to be reversed. So I think, I don't think there is anything that we should particularly mourn about the passing of hyperglobalization. And just to emphasize, I'm talking about a particular model of globalization, not globalization per se. Actually, I think much more highly of the Bretton Woods model of globalization, which is a kind of a thinner set of global rules and a shallower model of economic integration. But I think, it's both an opportunity. The reversal from hyperglobalization is both an opportunity and a threat. And depending on, what side of the bed I get up on, I think one or the other. I think the sense in which it is a threat is that the unraveling of hyperglobalization is very closely linked with the rising geopolitical tensions between US and China. One can easily see a scenario whereby what takes precedence over everything else is this kind of this zero-sum approach to the world economy, where international economic relations, trade and financial relations essentially become weaponized in the service of strategic and geopolitical goals by both major powers. And I don't think that is going to be a world in which we look at trade and finance purely from the perspective of sort of zero-sum relations, purely geopolitical considerations. I don't think it's going to be one that's good for the world economy, let alone world peace. The sense in which there could be a positive scenario is one where if we move to a world where we are in fact addressing some of the major domestic and international problems that were sort of overlooked under hyperglobalization, that we could actually create a healthier globalization that in many ways will look thinner in the sense that there will be less priority to international constraints and market access. But actually, just like Bretton Woods, will lead to a flourishing of international trade and long-term investment, because if countries essentially do the right thing for themselves, which is to look after their macroeconomic objectives, look after their growth, look after their social and equity agenda, and increasingly are taking on a kind of sort of the climate transition agenda as well, unilaterally through national efforts, as the US is doing to the IRA, then sort of healthier constituent units of the world economy, healthier national economies, will also actually create a healthier global economy as well. Because after all, the best thing that each nation can do to contribute to a prosperous world economy is to ensure that it has actually a prosperous national economy and a cohesive society that doesn't regard international trade and investment, other countries as threats, but as opportunities. So I think that is essentially was the lesson of Bretton Woods era, which is that you had very few international rules. Countries generally gave priority to their domestic economic and social agendas, but we got a world economy that was really thriving, where long-term investment and international trade really expanded very rapidly, because essentially, that's the precondition. Healthy national economies and cohesive domestic societies is a precondition for a for healthy global economy and healthy globalization. So that would be the good scenario.
Mm-hmm. Let me bring in Shekhar, who may be
Thanks very much.
Somewhat critical of your viewpoint, and also probably has a question or two of his own.
Thank you, Prakash. Dani, you mentioned the Bretton Woods era. So let me ask you about the Bretton Woods institutions. How do you think organizations like the IMF and the World Bank should be dealing with this moment? What kind of advice should they be offering their membership? And maybe since you mentioned the rivalry between US and China, just to throw something in there, a lot of critics point out that when you look at voting shares at the IMF and the World Bank, more than 50% of them are comprised by the US and Western Europe, which collectively comprise about 1/5 of the global population. So what kind of advice could they give which would be regarded as sort of impartial and in the best economic interests of their entire membership?
Yeah, I mean, I think that's the governance of the Bretton Woods institutions, and you're pointing to the voting shares, but I think one can enlarge the point in terms of who these institutions recruit, what type of economists work there, what is the nature of their engagement with client countries and so forth. I think there are some, deep issues there. And I think, these institutions have lagged in terms of adjusting to a world of significant amount of middle income countries becoming a much larger share of the world economy. I think to some extent this links up with the geopolitical issue that I don't think the US has really resigned itself or accepted a world of multipolarity. I think the US national security establishment is still dreaming of reasserting US primacy and hegemony in the world. And I think, it's sort of linked with my sort of pessimistic first scenario for the future of globalization that I was talking about before. So these are fundamental.
I believe we've lost Dani temporarily. I'm sure he'll log back on in a moment.
Okay. Sarthak, what if while Dani is coming back, I mean, what questions come to your mind about what you've heard?
Firstly, his comments were spectacular. It gave me a very good insight into the different perspectives related to globalization and deglobalization and hyper-globalization. While thinking about it, a thought came back to my head regarding India particularly, a country that is growing fast and well in the global landscape, but hasn't particularly grown spectacularly well on the industrial side of things, and currently relies on the service side of growth. How does deglobalization really affect a country like India and its industrial policies as a whole? I'm very curious to know how that would happen.
Hi, Dani. I think we lost you for a minute, but you were.
Yeah, I lost my internet, so I'm calling you on my phone.
Well,
I don't know at what point I got disconnected.
You had just finished talking about the governance of the IMF needing to acknowledge, and you were moving on to the fact that the US security apparatus has not gotten used to a world of multipolarity.
Yeah, so I was just, again, very briefly, because I'm sorry I got disconnected. I would say that the role of the Bretton Woods institutions in providing technical assistance to developing countries would be to really enlarge the space of possible remedies and instruments as they try to deal with their own economic problems. So, for example, one area where I think the IMF could play a bigger role is in helping countries experiment with different types of tackling capital inflows and experimenting with capital controls on inflows, because this is an issue that you well know, Prakash, has been a concern, but that the IMF has approached only very gingerly because of a certain, I think, economically unfounded affinity for free short-term capital flows. I think there are also sort of these institutions can play a bigger role for mobilizing support for global public goods. I think here again I would emphasize the role of climate change. I think in any kind of sensible green transition, developing countries will need to ramp up their investments in decarbonizing their economies. That's going to require both access to resources as well as access to technology, both of which are in the domain of rich countries. So mobilizing those resources, I think, is a huge priority that Bretton Woods institutions should lead on.
While we lost you briefly, Dani, there was a question from one of our students wondering what your world view implies for a large country like India. How do you think they are positioned? How do you think they should position themselves with a huge population that they have to find jobs for? What kind of industrial policies would work in that context?
Yeah. So I've been very much, I think that the kind of export-oriented industrialization model, which was very successful in fueling growth in East Asian countries, and also was a very successful job generation machine for them, for a variety of reasons having to do with innovation, with the history of globalization and so forth, is really not going to be working for countries like India or for low-income countries in sub-Saharan Africa. So I've turned into a bit of a skeptic as to how much you can do through policies that's going to promote manufacturing and export-oriented industrialization. So, whether we like it or not, I mean, I think, it's going to be services where the jobs are going to come from. And I think we need to think very hard about how to, engage in productivist strategies or strategies of increasing productivity in labor-absorbing services. That's going to be huge in India. And when I mean services, I don't mean IT and BPO either, because again, that's a sort of, it has only limited impact on absorbing the, very low-skilled and low-educated labor force in India. So this is really, we're talking about retail, we're talking about personal services. It's a very different kind of area. And how you engage in that is a difficult question. I think it'll have to be, much more decentralized approach, because, when you're dealing with these millions of micro enterprises, self-proprietorships and small enterprises, the kind of national industrial policy that we think of with industrialization really doesn't work. So I think it's a totally new area
Right.
of policy. On one other thing I would say about the role of middle powers like India is, again, to hark back to the earlier discussion on geopolitics. I think it's very important for countries like India to play a productive, constructive role in this context of geopolitical competition between US and China, which is to resist any approach to sort of to be drawn into one camp or another. I think middle powers like India or South Africa or Brazil or Indonesia have an important role to play to tell both China and the United States that, look, we don't want a unipolar system, whether it is the United States or whether it is China pushing for regional hegemony. The world is much more complicated and variegated than that, and then so pushing for a system of multipolarity where they stand both for their own interests and for the interest of a multipolar world seems to me to be important.
Thanks very
Dani,
much, Dani.
if I could just come back on one of your points. So, you express skepticism that manufacturing-heavy globalization can continue to be a path, despite the successes in East Asia, Vietnam, Bangladesh, many other countries. Why is that exactly? Is it because the nature of technology at the frontier itself has changed, and we are kind of moving away from the global manufacturing frontier, and services are expanding? Or is it because you think that the remainder of the countries don't have the infrastructure, or don't have the policies, or don't have the human capital to do the same thing that the East Asian countries did in an earlier era?
I think it's very much the first. I mean, I think it is the nature of technology in manufacturing, and the nature of competition, global competition in in manufacturing has changed to a point where if you want to be globally competitive in manufacturing, which means plugging into global value chains, you need to adopt technologies and quality standards that essentially have skill and capital requirements that are very far, from your own factory endowments. So what we used to say about manufacturing, which was largely true, for example, for China, that you could simply get farmers, peasants off the farm and put them into factory work, and not only increase their wages, but also increase productivity by a multiple, and that you could keep doing this for a long time. That no longer works. So, countries, either like Bangladesh are basically stuck at just ready-made garments, and, any sort of plausible path of diversification requires investments in skill and capital, which export-oriented industrialization was supposed to shortcut in the first place, because it was supposed to rely on your most abundant resource, low-skilled labor. Or in sub-Saharan Africa, you have basically countries that have tried that path, like Ethiopia, and find that very little employment has been generated in the export-oriented formal parts of manufacturing. The only really country that sort of has managed to avoid this conundrum so far, for a variety of reasons, in Vietnam, which is still doing reasonably well with manufacturing, but has been really has been lucky in a number of different ways in the last few years. But I don't see any other countries being able to replicate this.
Okay, well, thanks very much, Dani. I know you have to rush off to another meeting. Thanks so much for joining us. And
thank you. I appreciate it. And I'm sorry I have to miss Joyce's remarks. Thanks for having me.
Thanks. Let's turn to Joyce Chang from JP Morgan. I think you all know her, and again, her bio is in the event description. Joyce, welcome. Thanks very much for joining us. I know you two have other commitments this morning. So a couple of questions for you, Joyce. First of all, of course, any reactions you have to what Dani said and the extent to which you agree or disagree. But the questions I had for you were two. One is, to what extent is the deglobalization actually happening, disruptions of supply chains? And in particular, are countries really decoupling from China? And then the second question is about, what your thoughts are on what Dani spoke about the rise of industrial policy, its effectiveness, and what role should it play in shaping the composition of economic activity?
No, thank you so much. It's a real pleasure to be here. And as somebody with a background in emerging markets, I've been a long follower of Dani Rodrik's research, because it really does try to bring in some of the political and social dimensions. So I would just make three observations on the comments he made, and then I'm going to just turn to a PowerPoint deck that goes through a couple of these ideas. So first of all, I firmly agree that the U.S.-China geopolitical competition is really sort of reshaping the whole landscape of how we think about globalization. So that's the first thing I would say, and that emerging markets don't want to choose sides. I think we're going into a period of, just as there was a rise of the multilaterals, there's been a rise of the mini-laterals this time around, and a period of much more flexible cooperation, where I think countries will look at their own self-interest and form relationships based on that. So I do think U.S.-China is reshaping this, and agree very much that the U.S. often defines this in relationship to China rather than looking at it more broadly. The second point that I would make is just on industrial policy. We do see a rise of industrial policy. It's actually risen more in the advanced economies than in emerging markets, and it's very much focused on the tech sector. So for all of the reasons that Dani Rodrik mentioned, that is where I see sort of the next wave of industrial policy coming in, and also where the academic debate is evolving. I was at a seminar at Princeton last week where the whole debate was on just the case for industrial policy in response to supply side volatility, and really making a case that a lot of the mainstream literature has talked about how there has been crowding out of private capital when you put in industrial policy. And it was making really the case that there's a way to crowd in private capital, particularly when you look at some of the needs for investment related to climate change and some of the other areas that Professor Rodrik talked about. And then the final point that I would just make on Dani's comments is that that I do think that deglobalization is not yet reality, and that globalization shouldn't be considered a bad word. And what I'm going to show in this presentation, and this is a good segue into it, is that we've seen a shift in trading patterns, but we have not seen deglobalization. So let me just turn to the slides now. Okay, great. First of all, I'm not so much debating as probably agreeing with some of the points that Dani has made, but just taking a look at this, if you look at world trade as a percentage of GDP, it's basically stagnated since 2010. So you had this rise in globalization from 1990 through 2010. That was China's entry into the WTO. It was also the EU. But basically, you've had stagnation. And when you take a look at China's share of trade, it also has not gone down. Now, you do see a real change in US-China relations, but even here, take a look at the US-China chart. Even though you've seen that the tariffs have made a big impact, when you look at all of the other US imports from China, they're still above the levels that you were at before the pandemic. So I think that deglobalization is not yet reality. If you take a look at China, it still has a dominant role. And the question asked, can you really decouple from China? I think the answer is no. China receives about 338 billion of FDI flows annually. And there's no country that has the capability to absorb that, nor is there an alternative that has the infrastructure, a lot of the trained labor and engineers, and the scale that China offers. But this is only part of the story, and I hope you can all see the next slide. What we do see is that traditional trading patterns are being disrupted. There are new trade corridors that are emerging, and emerging markets fall into this as many of the sort of connector economies. But if you take a look at this chart, the red line at the top is US imports from China, which have converged with the imports from Mexico. So that's a big move on this chart, but there's more to this story. By our estimate, about 45% of the improvement that you see in US imports from Mexico has actually been Chinese suppliers relocating to Mexico and still exporting to the US. So, and this is because, labor costs are actually cheaper in Mexico for the first time in China in the whole 35 years that I've looked at China. You can also see that both China and the US have been increasing their exports to emerging markets countries, but the US and emerging Asia are still the dominant trading partners of China, despite all of the talk of decoupling. Turning to the next slide, other beneficiaries have clearly been Latin America, particularly Mexico and the ASEAN countries, but just also trying to work India into this discussion. So, FDI flows into India, have actually not gone up, and they've been around $70 billion. And even in Mexico, where it's been, quite stable at sort of 25 to $35 billion, we've not seen this major uptick yet. What we have seen is that as flows are actually coming back to the United States because of higher yields, higher growth, some reshoring policies, Mexico's been able to hold ground, and India is seen as having a lot of potential. But I come back to the point that absorbing 338 billion of foreign direct investment, is really something that I don't think it should be underestimated as something that's not Vietnam can't absorb all of that. But you can see that Vietnam, yes, has benefited. The LATAM countries, particularly Mexico, have benefited as well. And China's FDI flows have gone down to the lowest that we've seen in about 26 years. But I don't think there is a replacement for China, nor do I think it's prudent to think about it that way. Now, we have seen a pickup in trade restrictions here, and particularly on the commodities side. And a lot of people would say that 2022 marked the sort of geopolitization of commerce. And this was because of the introduction of the sanctions, also more trade restrictions on commodities as prices surged. We saw this even on food security issues. So you can see a very big uptick on the trade restrictions that have been on the rise. And that coincides with the uptick in rise in industrial policy that you can see correlates very well with the increase in sanctions and also in military conflicts. So I think that, look, just to summarize, deglobalization, I think, is a myth, but we do see a shift in trading patterns. The US-China relationship is at the core of this, but we have not seen China's share of trade go down at this point. US-China trade flows have shifted, but they have just simply, the other parts of the world, Europe is doing more trade with China right now, and so are the emerging market countries. And I don't think that decoupling is possible. Another question that I receive is, what about de-dollarization? Are we really seeing a move away from the dollar? And we're not seeing renminbi internationalization, but we are seeing diversification away from the dollar. And it's not just the China story. When sanctions were put into place and introduced, I think many emerging markets countries, really said, we don't want to hold as much in dollars in our reserves. So you have seen that US dollar reserve holdings have come down, an increase in gold holdings. But what this chart shows you is, one thing that was a windfall to emerging markets countries is that when Russia put in the oil price cap, emerging markets countries found that they could buy oil below market prices and also settle in non-dollars. And when you look at the way contracts are being executed right now, many of them are in non-dollars in the commodity sector. We estimate that about 20% of commodity transactions are now in non-dollars, and that's a really big move in less than 2 years. Also, if you take a look at what China has been doing, they have been doing much more cross-border settlement in renminbi. So it's not de-dollarization, it's not deglobalization, but it is a shift in trading patterns. It is also a diversification away from the dollar, although the dollar, everybody still wants to save in dollars. It is still not lost, its role in the payment system. I think de-dollarization is greatly exaggerated. And on industrial policy, there has been greater use focused on the tech side, with, I think, an evolving academic debate that's basically challenging some of the mainstream views that had held sway on industrial policy. That, when I was studying economics, a lot of the economic orthodoxy was talking about the inefficiency of industrial policy. And now I think you do see much more of a debate that is evolving right now on whether industrial policy could be a way to crowd in private investment rather than crowding out private investment. And you can see the proliferation of industrial policy, which I would point out has been more on the advanced economy side with the US Inflation Reduction Act, the CHIPS Act, and the bipartisan infrastructure law. Those are all some of the biggest industrial policies we've seen since the US sent a man to the moon. So those are just a few quick thoughts, and maybe I can just open it up for more of a dialogue right now for the next
Sure. Thanks, Joyce. I think that was an excellent set of points. Shekhar, would you like to come in, or would you like to ask something?
Maybe I could just ask one quick question. Joyce, you mentioned that, when we were in graduate school, we learned about the inefficiencies of industrial policy, and it's becoming sort of newly respectable. Isn't there a difference between industrial policy, which is essentially a way to cure externalities? So, for example, if we don't think enough is being done on climate change, then public infrastructure investment to crowd in private sector investment is something which even in the old days would have been regarded as fine as an economic argument. But many of the industrial policies that are now being introduced are things that specifically forbid, for example, foreign purchases in government procurement contracts, or try to limit the number of countries with which one can trade when it comes to climate projects or various other kinds of projects. So is there some kind of dividing line you would put in industrial policies as to what is beneficial and what's harmful?
Well, I think this goes very much back to a point that Professor Rodrik made, that just as there are many ways to define globalization, there are many ways to define industrial policy. And so I separate what I would term protectionism, tariffs and restrictions, from industrial policy, which can take many forms. It's not just public investment. It could be that, are you giving tax credits as incentives? Are you doing sort of some subsidies or some matching or taking some first loss, to encourage investment? So I think that is sort of the evolving debate that do we say industrial policy, and the mainstream view is immediately just the question that you asked, that this is about tariffs and protectionism and exclusion, rather than thinking about the way that industrial policy may need to be redefined when we really look at where the world is at right now, as far as like the tech revolution that's underway, right? And so the tech revolution really, to me, has three different dimensions. There's, of course, the AI dimension, but then there's the clean energy dimension as well. And then the third one is just bioengineering and healthcare, public goods. And so I think that I would start by saying that I wouldn't necessarily say that some of the measures that you put out, I wouldn't call them industrial policy as I'm defining it right now in sort of the new international order that's emerging of flexible cooperation, mini-laterals, and emerging markets not wanting to choose sides. But I think that, look, the arguments that, sort of putting distortions and tariffs are, sort of a global penalty, I don't argue against. I mean, and we've done a lot of work. A lot of questions that we receive are, what if a 10% universal tariff is put into place? And we think that would be 4 to 5% appreciation of the dollar, would have an inflationary impact, and it basically is a global tax on the rest of the world. So I think it goes back to, what is your definition of industrial policy? And some people, I think, do conclude when you say industrial policy, it's the same as protectionism. And I'm just trying to point out that there may be a different path for talking about what industrial policy is in sort of the new sort of tech age that we're in, which is also wrapping in Professor Rodrik's point that it's not about global manufacturing as much anymore.
Joyce, I'm asking a question on behalf of my student, Ahmad. Ahmad, if it's okay, I'll go ahead on your behalf. He's from Indonesia, and he had been asking me what it implies for a resource producer like Indonesia, this new age of deglobalization. I noticed on your chart that Indonesia did not seem to be benefiting yet as much as Vietnam or the others. Do you have a view on Indonesia?
I mean, I think that Vietnam clearly benefits, though, as a commodity exporter. I mean, it has not benefited in the same way that Vietnam has, which is for sort of assembly of goods, which is very different from sort of the resource angle that I've seen, from Indonesia. But I think as far as, Indonesia, its performance over the last couple of years during a period where there was a lot of, turbulence, it's actually been quite strong. And there's a lot of, investor interest that has, in Indonesia. I mean, I think there's actually more that you can do in Indonesia in some ways than in India, because I think India, for all of the potential, there isn't that much that's so investable for many portfolio investors, and they don't seem like they've been moving very fast, to really open up the opportunity that could be at hand. So I agree very much with Professor Rodrik's, point that that's one where it seems to me there's an opportunity that they could be moving faster than they have. I think that Indonesia, has moved to make sure that it is sort of seen as an opportunity, to make sure that it is open to that it's made an investment environment that is sort of open to it, and just given the size of the economy, I think investors are quite interested in Indonesia. But the point I would make is that for a lot of emerging markets countries, even those that are really doing the right things, pursuing the right policies, I mean, the US is sucking capital away from emerging markets right now. I mean, you've had that overall flows, into emerging markets have pretty much stagnated, because when you can get 5% returns in the US at the risk-free rate, that's also impacting Europe as well. It's not just the emerging markets countries. So I think one of the dilemmas I've seen for emerging markets is that even with the right policies and responsible macroeconomic management, they're not getting the kind of windfall that they would have hoped to have gotten, or that in the 1990s they received, partly because the US is kind of crowding out capital from the rest of the world right now, just given the yields it's being offered. I mean, look, if you look at Asia overall right now, where rates are at in Asia versus the US, you actually pay a premium to be in Asia.
Well, I know you have to leave, but if you can take one more question.
May I?
Yeah, go ahead.
One question?
Yes, please.
Hi, Joyce. This is thank you for sharing the data. I think that's very, very informative. My question is about the ESG. As countries are setting their own ESG goals. In your opinion, do you think that's going to, what kind of effect it's going to have on globalization?
No, so I think that a lot of these goals are very aspirational. I mean, we've not seen yet a peak even for energy demand from China, and look, what China owns in the ground is coal. So I think there are some aspirational goals, and there's a big question on what happens in the U.S. if it's a Trump 2.0, if there's an exit from the Paris Agreement again, if there's some rolling back on electric vehicles. So I find that there's just real differences on how the world is looking at ESG. I mean, it's mandated in Europe. There's definitely been some backing away from it from the US compared to a couple of years ago. From emerging markets, I think that their arguments have been very consistent that the cost of us to go to clean energy and net zero is so high that we're going to need support from the multilaterals, private capital that gets crowded in, and this has been a lot of the G20 and the G7 measures to say that this is sort of the fund that we're trying to set up for the transition. But I think there's kind of a reality check that's really going on, and how far that can progress and how quickly. I'm going to have to jump, but thank you so much.
Okay, thanks very much, Joyce. It was a pleasure to have you.
Take care.
Okay.
Bye-bye.
Bye. So, Shekhar, I think you're probably the skeptic in the room, or one of the skeptics in the room. Or so, what do you think at the end of 45 minutes of Dani?
Well, I mean, I think it's a fascinating debate, and it's clearly something that is very topical and it's happening in real time. But my own view on this is that we have had over the last 50, 60 years a remarkable relationship between trade and growth. And because growth is the most important factor by far in reducing poverty, between trade and poverty reduction, as a liberal, I view that as far more important than what's happening inside Western countries. So inside Western countries, maybe there's some increase in inequality, etc. I think from a universalist perspective, that is margin of error compared to the profound and transformative impacts that trade has had on developing countries. If you look at China and India, for example, they've contributed 80-90% of the bulk of global poverty reduction over the last 40 years. And for both of those countries, trade liberalization was at the heart of their reforms at the end of the 1970s, at the end of the 1980s. So I find it very worrying that we are going into an era where people are talking about protectionism, and most of the arguments are based on very Western phenomenon, whether steel workers in Pittsburgh are being adequately compensated by the winners from trade, etc. And to me, this misses the huge and transformative benefits of trade, which are not in Western countries, but in fact in the developing world. One more point, if I may, which is that industrial policy is thrown around as a sort of catch-all term. I think Joyce was right that we need to be careful about what we mean. If by industrial policy all that is meant is public sector infrastructure investments to crowd in climate spending and to crowd in public health spending. That's great. But that's a bit like motherhood and apple pie. It would be very difficult to find anybody who thinks that there's anything wrong with that, even under the old orthodoxies. If you look at the CHIPS Act, just to be specific, the CHIPS Act talks about giving subsidies provided that there are very severe restrictions on what you can buy abroad. You cannot buy Chinese solar panels and still expect to get subsidies under the CHIPS Act, even if those Chinese solar panels are much cheaper, much better, much more efficient, and would help with climate change in a much more rapid way. So I guess my dissatisfaction with this debate is that, the defenders of industrial policy tend to present it as a very benign sort of crowding in phenomenon without looking at the kind of exclusionary impacts that it might have.
Okay, so you're not convinced at all. That's good. No, that will continue the debate. So, did you have any views on what you heard?
No, not so much a view, but I want to ask Shekhar. I mean, can you give our audience, in your opinion, how should we measure the costs of globalization? I mean, besides the economic aspects, any other important aspects we should look at?
So in my view, there's a bit of a confusion, I think, especially in the West, where unfortunately most of the public discourse occurs, between globalization on the one hand and technological progress on the other. So if you look at the academic literature, for example, it's very clear that the rise of inequality in Western countries is more related to technological progress than it is to trade. So manufacturing employment has been declining over a period of 70 or 80 years. And that is nothing new. If you look at agricultural employment, for example, in the early 19th century, about 80-90% of the American workforce was engaged in farming. Today, that ratio is about 2%, and we produce more food than ever. So there are technological changes, deep structural changes that are causing a decline in manufacturing industries across the Western world. This is leading to a rise in inequality. And I think there are excellent public policy measures that could be put in place. Personally, I would be in favor of a universal basic income. I would be in favor of very generous wage insurance, pensions portability, assistance for job search, high quality public education, which today is not available on a level playing field in Western countries. So there are many, many things that can be done to kind of strengthen the social safety net and equalize opportunity. In my own view, protectionism and industrial policy would be at the bottom of the list of things that you should be doing.
Great. Thank you.
Let me turn to Ahmed and Amber and our participants. I see many famous people in our participants list. If you want to jump in, please feel free to do so. But let me turn to Ahmed. Ahmed, what did you think based on what you heard and what Joyce had to say about Indonesia in particular?
Yeah, thank you, Dr. Loungani, for the opportunity. I think for my country, Indonesia should see this trend in the globalizations as an opportunity that we should diversify our trade partners more. As the traditional market shrink or become more protectionist, Indonesia should diversify its trade partners to reduce dependency on any single country or region. I think this involves expanding trade relations with emerging economies and regions that are still embracing the globalization or have complementary economic structures. And the second, as the heavily natural resources producers, I think it's time for us to investing more in the value additions of our exports. And Indonesia could focus on moving up the value chain by investing in industries that add value to its raw materials. I think that is from my view regarding this.
No, I think her comments showed that she thinks there is a lot more that Indonesia could do to sort of exploit this moment than it has up to this point. I think she saw a lot of promise. Amber, let me turn to you to see if you have any thoughts on what you heard and what is your feeling about what this means for China from what you have heard.
Yeah, I'm now more curious about Latin America. I see like in light of the shifting global trade patterns, I have a question about like what opportunities exist for companies in emerging markets, particularly like Latin America, to capitalize their supply chain in relocations. Because I see like as countries that companies aim to diversify their supply chains to decrease reliance on specific regions like China and Latin America just become the point for investment and supply chain redirection due to its geographic location, abundant resources, and labor market.
Yeah, no, I think that's a very interesting thing that you saw in Joyce's slide and has also been talked about, the fact that Chinese suppliers may be relocating to Mexico, and so the redirection is happening through there. And it was interesting that we are at the point where Mexico's labor is, as she said, actually cheaper to China. So it actually makes sense for this would have made sense for China to be doing, perhaps in any case, to be relocating to cheaper locations, but it's kind of happening as a result of the tensions. But it may be a good long-term development that aids both regions. I know my colleague Felipe is on the line. I don't know, Felipe, if you have any desire to jump in and tell us something about what you think is going on. I don't know if he's still on the line. Maybe not. Shekhar, did you have a view on this? I think it's a very interesting kind of development that opens up really south-south trade.
So Prakash, we've just got a message on the chat from Felipe, which I can read out. As most of the increase of exports from Mexico to the US could be explained by the investment of Chinese firms in Mexico, is it not more interesting to analyze data from the dispute between companies' headquarters rather than their manufacturing locations? That's Felipe's comment.
Oh, okay. So do you have a take on, do you have a view on
no, I'm not an expert on this at all, but I can't help thinking that some of it may actually be due not to the labor cost differential, but due again to industrial policy. So, I'm aware that NAFTA, or the renegotiated NAFTA, had all kinds of local content provisions in it. And the local content included Canada, the US, and Mexico, but not China. So to the extent that Chinese investment can find a way around the local content requirements by having FDI in Mexico, it would circumvent that. But my feeling is also that the US is not very happy about this, and that there are currently political moves to make sure that Chinese FDI in Mexico does not qualify under sort of free trade agreements in North America. So we'll have to watch this space to see if this kind of thing can continue and expand, or if it's going to be ruled out by further political measures.
Right. I see that Felipe has joined. Felipe, what's your view on this emerging China or strengthening China-Latin America linkages?
Well, it's not only Latin America, right? Africa as well has a lot of investments from China as well. But overall, it's also related a little to the previous question that I made, is that developing countries should kind of take the opportunity here, try to kind of negotiate better with the investments from either the US or China in their economies in order to foster more development here. But I just want to give a final comment on this kind of industrial policy. Roughly speaking, I don't like it whenever you try to target like a sector or kind of firm size or whatever. I like to see these more in terms of the challenges and the opportunities that the firms face. Like, for example, what do I mean by that? It would be like either like promoting more export from the domestic firms to other markets. This would lead as, sorry if I say your name incorrectly, Shekhar, right? That said, I mean, trade is a huge engine for development in a way and reduce poverty. And if you will enable firms to like do more exports, do more innovation, I mean, those are what I call opportunities and challenges that the private sector faces in developing countries. An industrial policy based on that, they could be very successful in a way because you're promoting externalities there in those economies. So that's what I would like to add to the conversation here. I mean, industrial policy should be thought in a different way, not the way that we used to have in the past. So that's why would be my contribution here to the debate.
Yeah, no, I think that's the way Dani would want to phrase it and defend industrial policies as well. We have 1 minute. Sarthak, I'll give you the last word. What do you think about all of this at the end of almost an hour? And you have a minute.
Absolutely. Thank you so much, Professor, for the opportunity. I feel that it's a very dynamic environment where deglobalization might be happening and might not be happening, and the aspects associated with it are changing on an ever-changing scale. We also have the rise of the emerging powers on the global south that's important, and India's measures historically, at least as of now, have been regarding the promotion of the rights of those specific countries. So it's really interesting to see how that could play out in the larger conversation of the Bretton Woods institutions and the change of global dynamics, especially in terms of the power and the economic structure that each country offers.
Very good. Shekhar, we actually have half a minute. I'll give you the last word now. What do you make at the end of the day?
I would just like to thank you, Prakash, for organizing such a stimulating event with so many views. I mean, I think we've pretty much heard the discussion, and everybody can take home from it what they will.
All right. So thanks to our speakers, Dani and Joyce. Thanks very much, Shekhar, for joining me. Thanks to O, Felipe, and to our 3 students, Sarthak, Ahmed, and Amber. And we ended just on time, so Peter will be happy with us. Big thanks to Peter as always. All right. Bye-bye, everyone.
Bye.
Thank you.
Thank you.
Thank you.